Welcome everybody. Welcome to another installment of Thursday Thoughts. I'm Alex Leonida. I'm the CIO at Capital Financial Group, and this is where I sift through all the drama in the news and break down what I think is important for y'all to focus on. If you guys have any questions at all about anything that I discussed today, we'll try to get to some stuff real time if possible. But if you have questions for next week, shoot them over to info@cfgfinancialplanning.com. Also, just a reminder, don't forget to like and subscribe. I don't want you guys to miss any of this content. And we're putting out a lot of content right now. And on that front, we just launched CFGU, which it's a video and corresponding blog post type of deal. It's like a whole series that's going to discuss general financial planning topics for people. We think this is going to be real powerful for beginning financial planning clients and for your kids. It's going to be awesome for them just to start to build a foundation with their financial planning and their knowledge. So let's take a look at those, don't forget to take a look at those videos. I think they're going to be really, really good. It's something Cole's driving. This week, we are going to cover the same things as every week, and the order is just as a refresher. First thing on the list, we're going to do important data points. Numero dos, we're going into big news, stuff at least that I think is big news. Doesn't really line up with cable news, but hey, that's why y'all are here anyway. Number three, we're going to deal with some questions that came directly from viewers, and then we're going to end with the final thought. Normally it's kind of a rant, a little bit of a spoiler. I'm going to try not to rant this week, do the best I can. But first and foremost, I think we are going to get into the data right about now. Boom, data points, need it. We talked about jobs, right? Every single week, we're going to do jobs first because that is absolutely the most important thing from an economic perspective. This is the jobless chart. Should look pretty familiar to you guys. This is the one that we showed last week. Only difference is it's this week and the numbers are different, right? So the gold one, as a refresher, is going to be our continuing jobless claims. This is actually what a curve is supposed to look like when it's flattening, right? See, steep, then getting flatter. That's a flattening curve. This is not what the COVID curve looks like, but that is not what we're talking about right now. We're talking about continuing jobless claims. Initial jobless claims are in blue. They are leveling off a little bit here. Not quite as bad as the last 5 weeks. Not shocking, though. Not nearly as many people to get fired now. I mean, we just hit 36 million and change new claims in just a 6-month period. I mean, not an opinion here or anything, but I'm telling you right now, it is a fact. It is going to be hard to find work for all of these folks in the coming months. So this V-shaped recovery stuff that everybody's talking about, boy, I don't even know. I'm not sure how that whole thing is going to go down, but we've talked about it in the past. Hiring is so much harder than firing, and there are a lot of folks out there that are making a big chunk of change relative to what they used to make just by being on unemployment right now with the additional benefits from the government. We'll get into that a little bit more here in a hot second. Next data point this week, hot off the presses, Consumer Price Index, the CPI. That is a crazy chart. This is basically just a chart of what you guys buy and consume, all wrapped into some confusing statistical estimate that they're calling an index. Basically, I don't know. Negative 0.8 doesn't seem super dramatic, right? But this is a month-over-month chart of what I guess essentially amounts to inflation, right? This is a historic number. I mean, we've seen some pretty aggressive drops in the past. I mean, most recent memory, all we have to do is look at 2008. But don't take my word for it. We're going to go straight to the horse's mouth. The Bureau of Labor and Statistics would be that horse. And here's a breakdown of kind of what's going up and what's going down in price. All right. So the CPI for all urban consumers declined 0.8% in April. on a seasonally adjusted basis. Why they always say seasonal, like I don't know. I mean, they calculate it the same every single quarter, and every single month and every single year. But they keep saying that, and that's cool. This is the largest monthly decline since December of 2008. Why that is relevant though is like you see that huge spike in 2008. That's that really, really deep spike on the chart that you guys are looking at. I think it's important to point out that spike is so big because it's month over month over month over month of declines. Right now, we have 1 month of pricing data to work with. 1 month. So we have this massive decline that almost amounts to about half of what we saw in that entire downturn during the financial crisis. So after we have another couple months, I mean, I wouldn't be surprised to see this number look a lot like, or the chart to look a lot like what we saw in 2008. Back to the back to the Bureau of Labor and Statistics. There was a 20.6% decline in gasoline. Shocking. I know you guys are all seeing that at the pump. I mean, it's cool. It doesn't cost nearly as much to fill up. But we also saw huge decreases in apparel. We saw massive decreases in insurance, airline fares, lodging. Everything went down precipitously. On the flip side, we saw food indexes, especially food for home index, post its largest monthly increase since February of 1974. For y'all that are old enough to remember that, or you know your economic history, that was in the middle of a quasi-inflation crisis. So you can probably understand why this would be meaningful to compare it to that period of time. This one's pretty solid here, still from the Bureau. The index for all items less food and energy fell 0.4% in April. Once again, doesn't sound like a whole heck of a lot, but that was the largest monthly decline in history, which history is a long time, like as in forever, since they started calculating the index. Normally, I'd give you guys another data point here, but this week I'm feeling a little froggy. And I want to talk about one of my favorite metrics that I track on a daily basis, and that is the VIX, the volatility index. Whoa, did this dude come back hot and heavy this week? I don't know why he's a he all of a sudden. That's why this is live TV. The VIX, I guess it's an it, spiked quite a bit. It went from the mid-20s back into the low 30s Monday through Wednesday this week. Trailed off about 5% today. A lot of blab and a lot of talking coming from Congress on their helicopter money. We're going to get into that in just a second. But I want to concentrate on this chart just a little bit right now. I overlaid these gray pieces because they show existing recessions that occurred since 2000. I didn't want to make the chart too long because it would have gotten really hard to read and super convoluted, and we could spend an hour talking about this. So we're just going to focus on since the tech bubble. The VIX it's one of those things that has a tendency to spike when things are getting weird. Going back to its inception, it's only traded above 40 on a handful of occasions. One of those instances was about 6 weeks ago. And the other one was going to be back in 2008. Obviously, things were crazy weird back in 2008 too. The reasons why for these huge spikes are the same, but a little different. Let me explain. Leverage was the culprit for both of these huge spikes in the volatility index. Back in 2008, we were seeing all of this volatility from leverage on the sell side, or in this particular case, it was specifically banks and their ability to package mortgages together to sell, and then they'd repackage them and sell them again, lever them up, and then repackage them and sell them again. Yucky. We totally saw that did not end well. This time, it's a little bit different. This is where it's different, right? The buy side is the culprit, or retail investors, and people managing the retail investors' money. They were using margin, other forms of leverage to compound their exposure to the bull market that they thought was never going to end. And And if we look back to the tech bubble, I mean, the VIX, things got really bad during the tech period, and the VIX uh, only rose into the 40s. I mean, the reason behind that was there weren't a ton of ETFs that were 3 times leveraged long, whatever. There wasn't a ton of people using their margin to buy stuff. I mean, there were definitely day traders thinking they could buy and sell the next big thing with tech stocks, but the amount of leverage wasn't nearly the same back then. So that's why we saw that huge divergence in the VIX, and why it's so much more dramatic now than it was 20 years ago. So now it's time for the big news. Uh, I know this is going to be crazy. You guys couldn't possibly have predicted that I was going to talk about this. We have $3 trillion as the first big news piece. Yeah, this is helicopter money. I couldn't find a picture of Nancy Pelosi flying a helicopter, so we're just going to have to deal with Jerome Powell flying a helicopter. I mean, the money comes from the same place, no matter how you look at it. $3 trillion. That's how many dollars the House wants to throw at the economy with the bill that they're putting forth for vote. Last week's final thought, if you guys didn't watch that episode yet, that breaks this down into segments. But I really didn't think they were going to go for it. I just didn't see them going for it. I mean, I think this is like one of those like go big or go home type of deals. A couple of the items in this bill that are especially interesting to me. There's about $1 trillion, 980 something billion, that they're trying to give to state and local governments. I mean, that is a big, big number for the Fed to be giving to municipalities. Governor Newsom of California is going to be super sad about this because that dude wanted $1 trillion just for himself. I mean, he tried to mask it as saying the Western states need $1 trillion. But like, let's be real. What would it be if you didn't use a crisis to try to get something out of it, right? I mean, it only took decades to build a $1.5 trillion deficit in the state of California. So hey, let's try to get $1 trillion from the government. But they're not going to get $1 trillion. They're just going to get hundreds of billions, or whatever it says in the 1,000-page bill. I don't know. I haven't read it. But they're going to vote on that, and it's going to probably go down in flames. But that's a story for another day. The second interesting piece of legislation is the funding to extend the $2,400 a month for unemployment benefits. It was supposed to end in July, kind of coinciding with the PPP, which was for small businesses. But they're trying to extend it all the way into January of next year. And I mean, I think this is important to look at because they're essentially going to be paying people $2,400 more per month, give or take, of course, than they were making working for the next 7 to 8 months. I mean, how on earth are you expecting people to want to go back to work, like get off their couch and then take less money to go back to work? This is going to make the PPP loan forgiveness program a total mess. I mean, I can't even imagine how hard it's got to be for small business owners to try to rehire people or get people back on payroll so they can get these loans forgiven. We'll try to talk about that next week because that is like a whole nother story on why this is so challenging and why some of these bills are counterproductive, at least from my perspective. Like I said, I think this thing is going to, even if it gets through the House on party lines, it's going to go down in flames in the Senate. So speaking of senators, right, this guy. Also, I mean, great use of the mask. I'm pretty sure that it's supposed to like tightly cover your face or something. I don't know. I'm not a doctor, but that doesn't look right. This is Senator Richard Burr. He's doing bad things. Maybe, probably. I don't know. I'm just reporting the news here, right? If you don't know what I'm talking about, this dude is the chairman of the Senate Intelligence Committee. This inherently means that he's going to be privy to information that your average Joe doesn't get, right? That's a conflict of interest. And kind of ironically, he decided that he was going to go ahead and sit in on one of these meetings, and he was going to turn around and sell about 1.7 million of stock in his personal account. Yeah, that sounds fair. I wish somebody would tell me a bunch of like super doomsday information that's incredibly brutal and makes it blatantly obvious that the stock market's going to go down so I could sell everything, right? I mean, seriously, this stuff is absolutely ridiculous. Um, Ironically, he's also one of only three senators that voted against the Stock Act of 2012. Um, just a little history lesson if you guys don't remember what that is. It was actually a pretty good bill. It basically just made it illegal for members of Congress to use inside information to go out there and then subsequently trade stocks on that. That's called cheating, right? Um, I have more sketchy news to share, but I promised at the beginning I was going to do some feel good stuff. And what's more feel good than a really happy cow? Um, Kroger, the grocery store company, this is not a recommendation to buy or sell, is buying excess milk from dairy farmers and donating all of it to food banks. This is really, really cool. Um, all this extra milk is part of the supply chain that normally goes to restaurants and hotels. So I think that that's really really powerful because they have the ability to go in and they can process this milk and pasteurize it, and they can send it out to food banks. So that is really really awesome news. They're doing it to the tune of 50,000 gallons per month, and they're doing it all in a charitable fashion. So they're just taking this, pasteurizing it, and sending it out to food banks. Awesome job, Kroger. Love seeing stuff like that. So now it's time for some questions. We had a couple of good questions that came in this week. The first one has to do with interest rates. It's from a Fed perspective of trying to keep the economy alive with low rates for businesses and personal loans. This appears to be like an opportunity to take advantage of. What are your thoughts, big picture, for us and anyone borrowing money in this current environment while rates are down? That's a loaded question because leverage takes many forms and people use it for different reasons. But I would say right off the bat, I mean, if you have the opportunity to refinance your house, for example, and you have a mortgage that's at 4% and you can refinance for low cost at 3%, and it dramatically drops your monthly payments and you owe less in interest over the period of the loan, then I mean, that's a no-brainer. Uh, I'd like to caution people though, just because money is cheap doesn't mean that you have to go out there and lever up your personal balance sheet, go borrow a bunch of money and spend money that you don't have. I think it's opposite. I think this is a great opportunity for people to consolidate their debt, make really good decisions, try to lower their monthly payment, reduce the burden a little bit, pay things off quicker. I mean, these are all big positives in that regard. And something I'd like to point out too is money is going to stay cheap for a while. I think interest rates have to stay cheap for quite a while. And that's coming straight from the top. I mean, the Fed has to finance this debt somehow. And we need low rates on treasuries in order for this whole gazillion trillion dollar stimulus thing to be financeable, right? So as long as treasuries are really, really cheap, I mean, that means rates are going to be cheap for everybody else in terms of mortgages and everything. And there should be an opportunity for a while into the future for you guys to go out there and refinance your debt or make really good decisions about trying to save money in that regard. The second question we have kind of dovetails off the first, I guess. What's the deal with the housing market now that the market is back online? I guess the way it dovetails is the housing market is definitely affected by interest rates, and the fact that we have low interest rates on the surface, at least, that should be good for housing over the short to intermediate term. Obviously, on the flip side of that, we have a jobs debacle, which is a little bit scary. Not as many people working, not as many people wanting to buy houses. Fortunately, there's a lot of money flowing into the system, so it should keep the housing market afloat for a while. I could take this a lot of different directions, but I think one of the one of the most interesting little nuances in the housing market are these like little niche places where houses are just so atrociously, mind-blowingly expensive. Like we'll just use Silicon Valley, the Bay Area, like that whole like little micro region of California where home ownership is so unattainable. Um, let's use Twitter as an example to talk about this. And this is not a recommendation to buy or sell Twitter. But Jack Dorsey, their CEO, just told all of his employees that they can work from home literally forever if they want to. So think about that for a second. If you are like this genius coder and you live in Indiana and you get hired by Twitter, a year ago, they would have made you relocate to San Francisco or something. And let's say they gave you some kind of bonus and a really good salary. And let's say you're trying to buy a $2 million house. You know what you get for $2 million in San Francisco? Like mostly nothing. But I mean, if you're within, I don't know, 45 minutes of the city, you're getting like 2,000 square feet with a 45-minute commute, assuming traffic isn't that bad. Or you can chill on your couch in Indiana in a $2 million chateau on 10 acres, right? I mean, this is going to fundamentally change the home ownership market for these niche places like New York and San Francisco, whatever, forever. I mean, it is going to be changed forever. Not to mention the crazy changes that are going to be coming down the pike on the commercial side. But maybe we'll talk about that next week. The final thought this week is a little bit more lighthearted, I promise. I'm tempted to rant about our genius lawmakers and their moral fiber and the reasoning behind all of this stuff, but I'm going to stick with this like positivity theme that we have going on, thanks to Kroger and their awesome generosity. If you guys haven't heard yet, sports are coming back. Huh? Can we all just clap a little bit? That's exciting. Yes, sports. First and foremost, we got sports coming in hot this weekend. Some soccer or football, as they say across the pond, is coming back. Starting in Germany. There's not going to be any fans, obviously, but on Saturday, the Bundesliga, or I don't know how to pronounce that. I'm not good with German, but the Bundesliga is starting back up on Saturday, which I think is really, really cool. I mean, heck, I don't even watch soccer, and I might turn on a game just so I can watch some live sports. I'm not going to understand what they're saying, but that's beside the point. I just think it's really cool that we get some live sports back. From the world's most popular sport, which most of us don't really care about in the United States, to my favorite sport, golf. That's getting going again this weekend too, albeit on a much smaller scale. TaylorMade is doing a charitable thing with Rory McIlroy and Dustin Johnson, two of the best players in the world, against Ricky Fowler, one of the most popular guys, and Matthew Wolff, one of the big up-and-coming stars. They're playing a match at Seminole Golf Club, which is one of the most exclusive courses on the planet. So that's really cool because we're going to get to see that for the first time on TV. If you're a golf fan like me, that's a big deal. Next week, we have a really cool thing. We got Tiger Woods and Peyton Manning teaming up against Phil Mickelson and Tom Brady, all for charity once again. They're playing at Medalist Golf Club, which is another super exclusive golf club. That's going to be awesome next weekend. Of course, there's no fans with any of this, but it doesn't really matter. It's just cool that we have something to watch that's live, and then the actual PGA Tour itself is going to get rolling in the middle of June. And it's just exciting, I guess, because there's a light at the end of the tunnel for golf fanatics everywhere. If baseball is your thing, we got them potentially coming back on the 4th of July. The owners have a request in to start the season right on the 4th of July. I think this is awesome for America from a mental health perspective. We need a little bit of rah-rah right now. There's a lot of divisiveness in politics. The news is awful. This is just going to give us something else to do, something else to watch. And what's better than having America's national pastime start their season on Independence Day? I love the idea. So I hope that it gets approved. From a financial perspective, I mean, you guys know I have to tie a bow on this. No fans is bad. At least on the surface, it's bad. Food and beer sales are going to be non-existent. Ticket sales are obviously going to be non-existent. I mean, there's no butts in seats, so you can't sell any tickets. But what's cool is there's potential for huge ratings, massive. I mean, there's a cooped up and really bored populace just craving something else to watch other than ridiculously sad cable news. So this is going to be awesome. There's an opportunity for killer ad revenue. So that could be a little bit of a boost, at least in that space, at least for networks. And the general psyche of sports fans everywhere it's going to be improved, and that's exciting because we need something to look forward to. I think everybody would agree. So I did my part. I did a little positivity this week. And with that little happy nugget, I just want to leave you guys with this. I am very grateful for y'all hopping on and tuning in, watching me live. I know it's probably not easy to stare at this mug and bald head for 20 minutes every Thursday when you could be drinking happy hour with your loved ones. If this was your first time, please like and subscribe. We're doing this every single Thursday at 4 p.m. I'm sharing my knowledge with you guys, doing the best I can to keep you informed. And we're truly grateful for the opportunity to do this every week and this cool platform. Once again, if you guys have any questions for me at all, or anything that you want me to address, please send them to info@cfgfinancialplanning.com. And until next week, cheers. Thanks for watching, you guys.